Good evening, everybody. Welcome to the update webinar. We're going to get started here. Today's discussion is labeled Navigating Market Volatility, Insights, Strategy, and Expectations. Before we get started, there's some important disclosure information that our compliance team would like me to share with you. So when we send out this presentation, please take a few minutes to read through the details. The objective of tonight's meeting is one, to give our current clients an opportunity to engage in what we call ongoing due diligence. That simply means give them an opportunity to make sure that the services that we provide still meet their needs. It gives them opportunity to make sure that I'm still physically and mentally capable and able to manage their portfolios for them. It's a very important task they've entrusted me with, and want to make sure that they've got the comfort that we're here to serve them. Secondly, we want to introduce friends of the firm, prospective clients, to our risk management techniques, our different strategies, and how we approach the market. This is a great way for them to learn more about what we do. And always important, as Lois mentioned, there's going to be time to answer your questions about our investment strategies, our operations, how we do business. So please don't leave today without presenting your questions to us. Any that we're not able to address this evening, we'll certainly follow up after the meeting and make sure you get the answers that you need. Lastly, I want to take this opportunity, given the recent volatility in the stock market, to sort of clarify and reinforce expectations, particularly as it relates to risk management. This year, there's been some, what I might call, extreme volatility in the stock market. And this is just a really good opportunity to discuss what risk is, how we should align our portfolios to meet our financial objectives, and make sure that we are in the right place. So we're going to spend some time talking about that and making sure expectations are set so there's no surprises down the road. Before we get into that, though, I'd like to introduce the team. My name is Rob Bernstein. I'm president of RGB Capital Group. I'm responsible for all the day-to-day portfolio management, the investment decision-making, also all the client relationships. I'm assisted by a great team. My wife, Lois, who you've already met, she is responsible for our accounting and billing. She comes from an accounting background. She was with Deloitte Haskins & Sells for a long time, had her own accounting consultancy practice for 14 years, and now is helping us with some of the back office functions. We also have Stephanie Platt, who joined our team about 3 years ago, a little over 3 years ago. Stephanie is responsible for running what we call our client services desk. She's responsible for managing your needs and helping you set up new accounts, process deposits, withdrawals, address changes, beneficiary changes, all those things that support your account. Stephanie is in place to help us do that. And last but not least is Ryan Redfern. Ryan joined our firm about a little over a year ago. Ryan, as you see, has this designation after his name, CMT. That CMT stands for Chartered Market Technician. This is a globally recognized technical analysis designation. It really emphasizes data-driven, kind of rules-based decision-making, and really trying to eliminate some of the speculation and emotion that tends to find its way into the investment decision-making process. So Ryan has been in the business for quite a number of years. He opened his own firm in Austin, Texas in 2012, and is also supporting me in my business here. We collaborate almost on a daily basis. He's part of all the decision making, and our two backgrounds, he comes from a very technical, equity driven background. My background is much more on the what I would call more conservative side of investing. Really blends well together, and we really complement each other's skill sets. So great to have Ryan on the team as well as everyone else. I started RGB Capital Group. I actually changed careers back in 2009. At the time, I was managing money for myself and my mom, and it was really the 2008 financial crisis that kind of launched me into this business. And it's been a fantastic ride, enjoyed every minute of it. But I've always had a focus on risk management, and you'll see as we go through the conversation today that risk management kind of filters through everything that we do. At the time I launched the business, I was only managing money for myself and my mom. And she's still obviously my number one client, but we've brought on a lot of other clients along the way and hopefully have added a lot of value to those folks through some of these volatile periods that we've experienced. So let's dig in and talk about some of that volatility. This is a chart of the S&P 500. It's a large cap stock index for the last 25 years. And you can see that it's, had some ups and downs to begin with, but generally has had a nice run ever since the bottom in 2009. But there's certainly been a lot of volatility along the way. In early 2000s, we had the tech bubble, almost a 50% decline. That bottomed in 2002, 2003. The market climbed back, recovered those losses, only to turn around once again and decline almost 57% during the great financial crisis. This is when I launched my business, during this time period. Since that time, the market has trended up nicely, but it hasn't been without its bumps in the road. 2011, we had what I affectionately call the debt ceiling debate. Members of Congress were debating whether or not to raise the debt ceiling. Had we not raised the debt ceiling, there was the risk that the US may not be able to meet all of its financial obligations. This obviously created some uncertainty in the markets, and the market sold off. In 2015 into 16, there was concerns of global growth. I call this the stealth bear market. The reason I call it the stealth bear market, usually bear markets are considered 20% declines or more. The S&P only fell 14%. But if you look at some of the other indices and other portions of the market, small caps, mid caps, for example, they all fell 20 to 30%. This bear market didn't get a lot of attention because the large cap stocks didn't do all that bad relatively, but it was certainly a point in the market where risk was elevated. We had the Fed fumble. The Fed was raising rates in 2019 and held steadfast that they were going to continue to raise rates in 2018, and they were going to continue to raise rates into 2019. The market at the last quarter of 2018 sold off, was not in agreement with that approach. Jerome Powell, the Fed chair, finally succumbed and stopped raising rates, eventually started lowering rates later in 2019. And when that happened, when he made that pivot, the markets took off. And then, of course, the global pandemic in 2020, that was a 34% decline for the S&P in a matter of 23 trading days. That was a very fast decline. We had the inflationary period, the 2022 bear market, which was a 25% decline. And then most recently, we had our tariff tantrum this year. It hasn't recovered all those losses, and that's why I put a question mark there. Certainly that tariff concerns could come back to surface. For right now, they've recovered the majority of those declines, but so far the maximum decline was 18.9%. Now this decline this year, the tariff tantrum, was, I think, a little interesting. It seemed to be very emotional for a lot of people, and I think that was because there was some political backing behind people's reaction to this. This political bias really colored our response to this market. I talked to people who loved the fact the market was declining. It was creating a great buying opportunity. Those were folks who really supported the Trump administration's policies. If you didn't support them, it felt like the market was beginning to collapse, and we were in unprecedented times. Here at RGB Capital, we don't really invest based on political leanings, right or left. But we base our decisions based on what the market's doing. And we treated this tariff tantrum like no other pullback that we've seen over the last 25 years. Interesting that this tariff tantrum was actually on this list of crisis situations that we've seen over the last 25 years, didn't even make the top 5. But it sure felt, because of the news headlines and the media driving kind of fear in investors, it certainly felt a lot worse than it was. So I wanted to just kind of set expectations. We get a few more calls, I would say, than we normally do. And just want to use this session tonight to kind of reset expectations. The time to address your risk tolerance and make sure that your portfolios are aligned with your tolerance for risk is when times are good. Now would be a much better time to address that question than in the middle of a crisis. And so we're going to see how our risk management techniques performed during this most recent crisis to give you an idea of why we shouldn't be making those changes in the heat of the battle, if you will. But before we do that, I want to talk a little bit about risk itself. This chart I've shared with folks many times. This is a chart that the gray shaded area is the loss that you could potentially incur in your portfolio, and the orange area is the gain required to break even. You can see the bigger the loss in your portfolio, the higher the return you need just to break even. So a 10% loss would require an 11% gain to break even. A 50% loss in your portfolio would require a 100% gain to break even. So think about it. If you had $1 million portfolio and your portfolio declined by 50%, you would be left with $500,000. You would need a 100% return of that $500,000 just to get back to that million. So you can see the further you go down into the hole here, the exponentially more difficult it is to recover. Anyone heavily invested in tech stocks during the early 2000s might have experienced a 75% decline. You can see here a 75% decline would require a 300% gain to break even. Those large gains don't come by very often. And there's an opportunity cost because it typically takes a long time for it to happen. So focusing on the downside losses is an important aspect of our investing approach. I also want to talk about drawdowns. There's a concept, term I use quite often. It's called drawdown. A drawdown is simply a percentage decline in the value of your investment or your portfolio from a peak to a trough before a new peak is reached. So I've just used the B of A Merrill Lynch High Yield Master 2 Index. This is an index of the US domestic junk bond market. You can see here, as an example, it peaked at this point and fell to this point. This was a 35% decline before it bottomed and exceeded its previous peak. This was a 9.7% decline. This drawdown here was 13%, 21%, 15% in 2022, and most recently, the junk bonds held up relatively well during the tariff tantrum and fell only 3.8%. So as you can see, a drawdown is simply the percentage price decline, or the percentage decline in the value of your portfolio or an investment from peak to trough before it bottoms and exceeds its previous peak. There's another term that I will use frequently, which is maximum drawdown. A maximum drawdown is simply the largest decline, largest drawdown over a fixed time period. So in this case, this time period is quite large. This is about a little over 25-year time period. The maximum drawdown was this 35% decline. So this is a very tangible measurement. Most investors can get their arms around it. They can open up their statements from their brokerage accounts. They had $1 million and now they have $900,000. They know they've experienced a 10% decline. So that's why we like to use this, and it's something that we like to avoid. So we want to bring it to the forefront and focus on it to try to minimize drawdowns as much as possible. This drawdown chart focuses on drawdowns. It's a way to visualize drawdowns for different investments, whether it be your portfolio, a mutual fund, or an index. And the way this works is you can see that the percentages here represent the drawdown from a recent peak. You can see 5, 10, all the way down to 35% here. And it shows how long it stays in that drawdown state until it reaches its previous peak. Once it surpasses its previous peak, it goes flat. It doesn't show the upside, it just shows the downside. And again, this just helps us highlight those drawdowns so that we can make a comparison and visually see what those drawdowns look like. This is a drawdown chart that represents the junk bond index we looked at on the previous slide. You can see this was that maximum drawdown of 35% here in 2008. But you can see the other drawdowns, almost 15% here, 13, 14% here. This was over 20%. This was 15%. And you can see most recently in this tariff tantrum, we had a relatively small, I think it was 3.8, almost 4% decline. So we're going to use this throughout the discussion tonight as a way to compare drawdowns in different portfolios that we manage. Lastly, this is the last piece about managing risk. This is what we call a risk reward chart. The way we read this is on the x-axis on the bottom here is standard deviation. Standard deviation is simply a measure of volatility, and volatility implies risk. Lower volatility on the left side of the screen, higher volatility on the right side of the screen. On the y-axis, we have annualized return. You can see for this time period spans from 0 to 12%. What I've done here is I've plotted some major stock market indices, Treasury Index, also a Vanguard Prime Money Market Fund. And you can see with this line that I've drawn, this is a regression line, just a line that best fits these 6 data points on the screen. There's a trade-off between risk and return. The more risk we expose ourselves to, the more return we would expect over a long period of time. Now, not every investment or portfolio is going to fall right on this line, but I've drawn 2 parallel lines, and most investments, not all, but most investments are going to fall somewhere between these 2 dashed lines. This is what I consider the long-term expected return channel. And you can see that trade-off between risk and return. Now, as investors, we have complete control. We have control over how much risk we take. We do not have control over the return that we're going to achieve for that given level of risk. Let me clarify that with an example. So, what do I mean by we can control how much risk we expose ourselves to? Let's say we had a portfolio. We have the choice. We could invest it all in a Vanguard Prime Money Market Fund, or we could invest it all in the NASDAQ Composite Index. If we invested our portfolio entirely in a money market fund, we know that our risk profile is close to 0. Money markets are designed to maintain their dollar value. We have a high level of confidence that we're not going to be exposed to a lot of risk. It's not riskless, but there's just not a lot of volatility. On the other end of the spectrum, we could put our entire portfolio in the NASDAQ Composite Index. We know that's a very volatile index and can move up and down in large swings during certain periods of the market. So you can see we could put ourselves here at this end, or we could put ourselves here at the higher end. Given the tools that we have available to investors today, we can really craft portfolios by combining different investments to sit anywhere we want on this volatility axis. What we don't have control over is how much return we might get during any given time period. Let me use the money market as an example again. Money markets over this long time period, this chart was based on data from going back to 1996 through 22. The average return of money markets was 2%. However, we know for quite a while after the financial crisis, money markets were paying basically 0. So for a while there, we were getting 0. Over the last couple of years, money markets were once again providing some interest and some return, and they were paying up in the 5.5 range. So that's all based on market conditions. We don't have any control over that. What we do have control is how much risk we expose ourselves to. My job for my mom and for all of my clients is to take a step out on this risk scale and try to achieve as much return as we possibly can. Again, I can control where we sit on this volatility axis and do everything in my power to get as much return as we possibly can for that given level of risk. However, understanding that that's based on market conditions. We'll look at how these strategies have done over time. And what I hope you will see is that we've been able to manage volatility towards the lower end of the spectrum and achieved returns that far exceed this long-term expected return channel. What I would like to do is just change gears here, talk a little bit about our services. We offer two levels of service. We have our tier one discretionary investment advice that we provide to our clients. What that means is our clients give us discretion to make investment decisions on their behalf based on the objectives that are stated in the portfolios that we manage. We also provide another level of service, which we call our tier two service. This is designed for individual investors who want to manage their own accounts using our professional trading platform at Fidelity. These clients make their own investment decisions. RGB Capital Group is not part of that investment decision-making process. What we do is simply open a window to our trading platform that provides you access to some of the tools that we have that may not be available at some of the discount brokerage houses. The majority of our time is spent with the tier one services, but we provide the tier two services as a service to individual investors who want access to some of the tools that we have. I'm going to talk a little bit about the tier two services, and then the remaining portion of the discussion this evening will be focused on our tier one services. So just real quick for anyone who's interested, our tier two services, as I said, are designed to provide a window to a professional trading platform for investors, individual investors who want to trade their own accounts. They are going to make their own investment decisions. They're going to do their own research, and they're going to implement those trades through this trading platform. And the trading platform is really no different than, a brokerage account that you might have at Vanguard or Schwab. You'll log on, you'll see your accounts, you'll have the ability to place trades, you can see your positions. All that's provided through Fidelity. Really, the unique part of this service is that the Fidelity trading platform that I would provide access to allows our tier two clients to get access to many of the institutional share classes at no cost and no initial minimum. If you're familiar with trading mutual funds, institutional shares tend to be the cheapest share classes available. They tend to come with some transaction fees and typically have very high minimums, anywhere from $1 million, $2 million, $5 million just to get access into the fund itself. The trading platform that we provide allows individual investors, for the most part, to get most institutional share classes at no cost and avoid that high initial minimum. We also provide access to many of the A shares. A shares is just another mutual fund share class that tends to come with a front-end load. That front-end load could be anywhere from 2.5% to 5.5%, meaning when you buy the share, they take that 2.5% to 5.5% off the top. You're already in the hole trying to recover. So for most instances, A shares don't make a lot of sense unless you can get them without this front-end load. And that's what the trading platform allows us to do. We also have attractive margin rates compared to many of the retail brokerage firms. We charge a very nominal 0.1% per year. That's considered 10 basis points based on the assets that we manage. And we ask that the accounts be opened with at least $50,000. So now going forward, we're going to talk about the RGB Tier 1 services. As I said, these are services that we provide on what they call a discretionary basis. It's focused, all of our strategies and services are focused on managing risk and preserving capital when the markets are weak, and then reducing emphasis on risk management when market conditions are more favorable. We certainly want to participate in the upside of the market when conditions are favorable. We just don't want to participate in a lot of the downside. The degree of risk management that is applied to any client's account is based on their tolerance for risk. So we always upfront have a discussion about a client's risk tolerance and try to get them aligned with a strategy that will allow them to sleep at night, be comfortable that they are in the right place based on their financial objectives. We deliver all of our investment services through what we call a model-based approach. There's 3 investment strategies with different risk profiles. I'll talk about those 3 strategies this evening. The fees for our services are 1.75% of the assets we manage, or for what we call qualified clients, there's a performance-based fee option that 1.75 is reduced down to 1% of the assets we manage, plus a share of the 10% of the gross profits. We request that all of our advisory relationships have a minimum of 250,000 to start that relationship. So let's get into the fun stuff. Let's talk about the strategies themselves. On the left side here, you can see we've got three strategies: the core, the balance, and the flex plus. These three strategies vary based on the level of volatility that they're exposed to in the market, with the core strategy being our lower volatility strategy and our flex plus being the higher volatility strategy. The core strategy is focused on preserving capital during periods of market weakness. We try to achieve as much return as we possibly can when the markets are favorable, but we do it on volatility that's significantly below that of the market, typically 1/4 to 1/5 the volatility of the stock market. On the other end of the spectrum, our Flex Plus strategy is a more aggressive equity focused strategy, trying to participate in a lot of the upside of the stock market. There is some risk controls that are put in. We try to protect during protracted bear markets, but this Flex Plus strategy is going to have a much higher volatility profile, which is going to be much more like the stock market itself. The balance strategy in the middle is a nice blend between the two. It is actually developed based on a 60% allocation to the core and a 40% allocation to the Flex Plus, and provides a nice balance between, capital preservation and growth potential. And it's actually a nice sweet spot, I think, for quite a number of client portfolios. Now you can see across the top, we've got two flavors of the core and the balanced. One is for our qualified accounts. A qualified account is simply a tax-deferred or tax-free account, like an IRA or a Roth IRA. Our non-qualified accounts are our taxable accounts. And the reason we have different flavors for qualified versus non-qualified is that in our core strategy, we have the access to an additional tool in our non-qualified accounts. And that tool is what we call margin. Margin is simply borrowing funds from Fidelity and using them to invest in the market. Now, of course, we do that in a manner that does not overly increase risk. In fact, it increases risk very incrementally, and I'll show that to you in a few slides from now, where our core qualified, or CQ, does not use margin. So we have a margin version, which is our core non-qualified CN, and a non-margin version, which is our CQ strategy. Because the balance strategy is a 60% allocation to the core, the balance qualified does not have access to margin, and the balance non-qualified mimics the 60% of the margin use with its sleeve that's allocated to the core strategy. The Flex Plus strategy does use leverage, but does not use it in the form of margin. We'll talk about how it does it, but this form of leverage is accessible to both qualified accounts and non-qualified accounts, and that's why there's not a delineation between the two. So we're going to dig into all three of these strategies. So we're going to look at what makes them run, how they've performed, and the process that we use to achieve our results. Starting with the core strategy. The core strategy is a very tactical, risk-managed strategizing. Tactical just means we're moving into and out of the market based on our buying and selling signals that we get. And the primary goal of this strategy is to preserve capital. When the markets are weak, our primary goal is to make sure we do not experience steep losses. We can't avoid all losses, but we try to minimize those losses to the extent that we can. It does seek to achieve reasonable returns when the markets are favorable. And as a result, we are striving for strong risk-adjusted returns. As I mentioned before, we want to have volatility that's significantly below that of the market, typically sort of 1/4 to 1/5 the volatility of the overall market. We use mutual funds and ETFs to get exposure to the market with our entry and exit points that I mentioned. We do selectively use margin in our non-qualified accounts, and then cash is used proactively to reduce exposure during riskier periods. When everything's going down, cash is a nice place to be in a valid asset class to protect our capital. So let's take a look at how the core strategy has performed over the last 10 years. There's a lot going on in this chart, so let me kind of walk you through this. Starting with the 4 lines on the chart, the orange line is our core non-qualified strategy. This is the one with margin. The CQ is our core qualified. This is this core strategy without margin. I've put 2 indices on here to give you a flavor of what's happening in both the equity markets and bond markets. The RGB market index is a equally weighted average of the S&P 400, 500, and 600. So that's mid-cap stocks, large-cap stocks, and small-cap stocks. There's not a perfect benchmark or comparative. Every index is a little different. I think by combining these 3 in an equally weighted average, as I've done here, gives us exposure to about 1,500 stocks in the market. It provides exposure to different capitalized weighted stocks, being large, mid, and small. There is no perfect index, but this certainly gives us a flavor of what the market was doing during that time in the gray line. The teal line here is the Barclays Aggregate Bond ETF, AGG. This gives us a sense of what's happening in the bond market. Just visually looking at the 4 lines, you can see the blue and the orange line have significantly less volatility than the equity index and the bond ETF. Just by observing how the line doesn't move up and down as frequently, it's much more of a straighter line. And that's our goal at the end of the day, is to create this lower volatility experience for all of our clients. Looking up at some of the quantitative stats up here, we'll start with some of the returns. You can see the 1-year return for the 2 strategies, somewhat comparative to the bond strategy over the the bond ETF over the last year. Certainly outperformed the equity index over the last year. 5-year returns, pretty, a little under the equity, but certainly outperformed the bonds. 10-year, they're all, the 2 core strategies, both core non-qualified and core qualified, are somewhat in line with the equity indices and outperformed the aggregate bond ETF. Now, where I think it gets interesting for me is around the risks side, the risk characteristics of these 2 strategies. If you remember before, what we can control is the risk we expose ourselves to. So the maximum drawdown compared to the equity index is significantly less. You can see this equity index had almost a 40% drawdown. That was down around here during COVID. The maximum drawdown for these 2 strategies is just around 7%. So you can see that's less than a fifth of the volatility as measured by maximum drawdown. Even the bond ETF, the portion of these, what we call strategic asset allocation strategies, the bond portions are intended to be shock absorbers to absorb the fall when equities are starting to move down. They even had some significant drawdown during this 2022 period. Standard deviation measure of volatility, you can see significantly less than the equity index and the ag index itself. One last thing I want to highlight is just the difference between the core non-qualified and core qualified. The core non-qualified has selective exposure to margin. We don't use margin at all times, but you can see the additional volatility that was attributed as a result of using margin is pretty minimal. You can't really visually see a difference in the level of volatility. When you look at the measurements here, they're pretty close. Core non-qualified is slightly higher than the core qualified, and the drawdowns are fairly close. So we didn't really increase volatility significantly by using margin, but we have increased the returns. In this case, over the last 10 years, we've increased returns about, 1.5-ish% on an annualized basis. So quite a useful tool, in my opinion, during certain market environments. As I said, we don't use margin all the time, but selectively in positive market environments, it certainly has paid off and allowed us to increase our returns in that portfolio. So I know all of you are interested in looking at what's happened more recently. So what I'd like to do is just zoom in here. This is a 1-year chart. The 4 lines are the same that we saw in the last chart, but it shows the performance over the last year. You can see performance of the equity markets had quite a significant drawdown from this peak to this trough. That maximum drawdown was just over 23% compared to the core strategies, which were just under 2 and a little bit over 1 for the core qualified. You can see the volatility levels for the 2 RGB strategies is pretty similar to what we saw over the 10-year chart, less than 1%. And all of these are significantly less than that of the stock market itself. You can see this is about 1/6 that of the stock market, and these are about 1/2 the volatility of the bond index. So again, our goal here at the end of the day is to manage risk and provide reasonable returns, which I think we've accomplished both over that 10-year time period as well as this shorter 1-year time period that we're looking at here. So let's look at these drawdown charts. On this chart, this is for our core qualified strategy, which is the orange line, versus the Barclays aggregate bond in blue and the equity index in gray. Again, this just allows us to visually compare the drawdowns over time. You can see the drawdowns of these equity indices were quite significant, both here and here. This was during the 2008 financial crisis. This was over 55%. And you can see that the core qualified typically has drawdowns that are much less, are less than 5%. We had a drawdown here in 2018 that was slightly over 5%, but quickly recovered. Even the 2022 was it was at about 2.5%, and more recently in this tariff tantrum, this chart goes through April 30th, 2025. You can see there really wasn't much of a pullback at all. So hopefully that gives you a visual representation of the reduction of volatility that we provide. I've now changed the slide. You may not have noticed, but we are now in the non-qualified strategy, or CN. The gray and the blue lines are the same as before, and the orange line is the core non-qualified strategy. You can see a very similar pattern, very low drawdowns. The largest drawdown here being during the 2018-19 pullback. But even during COVID, here's COVID. We had very small drawdowns in the 5% range during the 2022 bear market, but even more recently during the tariff tantrum, very, very small drawdowns. And again, remember, reading this chart, anytime it goes back up to the 0 line, it just goes flat when we're creating new highs. So all these times where this is flat, we're creating new wealth. Lastly, wanted to show you how this all looks on a risk-adjusted return chart. What I stated earlier was my objective was to try to take a small step out on the risk scale and try to achieve as much return as we possibly can. And that is what we have done. You can see volatility is slightly higher than a money market, which is what this Fidelity Government Cash Reserves is, and significantly less, almost half that of this Vanguard Total Bond Market Index. At the same time, the core non-qualified is provide returns equivalent to the S&P 500. So what I like to say is these are providing equity-like returns on bond-like volatility. So if you like these types of returns and you appreciate the reduction of volatility, if that allows you to sleep at night, this certainly is a potential candidate that could add value to your overall financial plan. But again, we're trying to move up into the upper left-hand quadrant of this chart. And I think since inception, we've been able to accomplish that goal. So how do we achieve those types of returns We're not going to go into a deep dive, but I just wanted to give you a high level of how we accomplish some of that. Historically, we've used what we call moving average timing. I'm just going to go through this concept really quickly, just to give you an idea of what are some of the things that we look at when we're making decisions on what to buy and what not to buy. Historically, we've used moving average timing with low volatility funds. One of the volatility asset classes that I consider as the epitome of the low volatility asset classes is our junk bonds. And in this top panel here, this red line is this junk bond index. We referred to it earlier. When it's trending up above its 50-day moving average, it tends to indicate that market risk is low and the market environment is relatively positive. So we want to be invested. When it drops below that 50-day moving average, we want to move to the sidelines, move to cash to protect our capital. So during this time frame, you can see that the index was above its 50-day moving average for most of this year, fell about 1%, crossed over at this point, and then declined another almost 9% from this peak to this trough. Now, if we got out here and got back in here, that would allow us to minimize downside risk and maintain a lot of our principal during the weaker market environment. If you look at this bottom panel, there's actually two lines here. There's a red line, solid red line, and a composite line, which is a red and green line. The composite line, the red and green line, is the results of moving into this junk bond index when the index is above its 50-day moving average, and moving to a money market when it drops below that 50-day moving average. So you can see that the annualized returns of this index was just under 3% for this year. And by making these two trades, we increased our return from 3% to 9%. So that's always positive, right? We always want to strive for as much return as we possibly can. However, what I think is more important is that we've reduced volatility. We've reduced volatility from 1%, which is already low, to 0.5%. So we have lower volatility, higher returns. That gets us up into that upper left-hand quadrant of that risk-reward chart that we were looking at previously. Now, if we were to look back 25 years, this is what the results would be. So the top panel, again, is simply the index itself. The purple line that you can barely see there is the 50-day moving average. On the bottom panel, you can see the red line is simply the index repeated again, and the composite line is the results of moving into and out of junk bonds, the junk bond index, in cash based on its position relative to its 50-day moving average. Just visually, you can see we've avoided all the large drawdowns like here, and again here during COVID, here during this pullback in the 2022 inflationary period. And at the end of the day, we're able to increase returns from 6.4 to about 9.8. Again, always striving to achieve as much return as we possibly can. However, more importantly, volatility was decreased by almost half, went from 1.5% down to 0.8, let's call it 0.9%. Again, lower volatility, higher returns. Now, we've applied historically this to junk bonds. There's other low volatility asset classes that we've used, including floating rate bonds and preferred securities. After COVID, there was an asset class which I call securitized credit. They provided some really fantastic low volatility returns, and we were able to achieve those using this concept of moving average timing. However, markets are dynamic and they change over time, and so we need to be adaptive with our approach. And more recently, the interest rate environment has had an effect and an impact on some of these lower volatility asset classes. And when I recognized this, I started to look for other opportunities. And so more recently, I want to share with you a strategic shift in the way we've been managing a portion of the portfolios for our core strategies. What you're looking at here in this green line is what we call a market neutral index. The index is made up of an equally weighted average of market neutral mutual funds. What a market neutral mutual fund is simply funds that have low correlation to the overall stock market. They're intended to move up, whether the market's moving up or the market's moving down, that they're designed to and strive to continue to move up in a positive direction with very low correlation to the stock market. And so what I've noticed was that these market neutral funds were performing relative to, say, junk bonds in a manner that provided better risk adjusted returns. And I think part of that had to do with the interest rate environment. Because the interest rate environment has become more volatile, we're getting a lot more pullbacks. As you can see here, this red line is the results of that moving into and out of the junk bond index with its 50-day moving average. So this is the resulting line. You can see we get pullbacks. They're not very big, but then we get little pullbacks here. And then again, more recently, we got a little bit of a pullback during this year, 2025, when the tariffs were implemented. But you can see during all these time periods, this market neutral index continued to move up. And so when I recognized this, we strategically made a shift in our allocations to weight our core strategy much heavier to these market neutral funds, and it's really paid off. That's what allowed us to manage through the April sell-off when the tariffs were announced. It's not because I knew or Ryan knew that the tariffs were coming. It's because we look at the overall risk and return profile and try to stay current with the market by looking at a lot of charts on a daily basis and try to move our strategies to those parts of the market that are going to provide us the best risk adjusted returns. And you can see just by comparing this market neutral index to the timed strategy, we've got higher returns, 5.5 compared to 9.9. But again, we're doing so on 10% less volatility. So again, we get higher returns, lower volatility. Those are all the characteristics that we're looking for when we put together these portfolios. So hopefully that gives you an idea of the process that Ryan and I go through when we put these strategies together, and how we make some of the decisions that we do. And hopefully that provides you, for those of you who are in the core strategy, the confidence that when the markets get weak and the headlines are pretty scary, that we're just not participating in the market volatility that you see on the news every day. So with that, I want to shift gears. We're now going to talk about the Flex Plus strategy. The Flex Plus strategy, as I mentioned before, is our more aggressive strategy. This is certainly focused for much longer term capital. It's focused on equities. We want to participate in capital appreciation during strong market environments. The way we do this is using technical and market indicators to assess the overall market environment. What are the trends and how do we want to lean into and lean out of the market based on what we're seeing in this environment? So when the market is weak, we want to kind of reduce our exposure. When the market's favorable, we want to kind of lean in, increase our exposure. And we also have the ability to use leverage. Again, this is not margin, but we have use of ETFs that provide us exposure to 2 times a market index. So for example, if the S&P moves up 1%, there are funds we have access to that can move up 2 times that on a daily basis. So if S&P moves up 1%, this fund is going to move up by 2%. If the S&P drops by 1% in a day, this fund is going to drop by 2%. So we certainly want to lean into those in favorable market conditions, and that's going to help increase our upside potential. Most of our exposure in this strategy is obtained through exchange traded funds, or what we call ETFs. At the end of the day, given the higher volatility nature of the Flex Plus strategy, it's designed to get the big moves in the market mostly right most of the time. Now, just for some context and some history, the reason I developed this strategy originally was to pair it with the core strategy as we do in the balanced strategy, which we'll talk about next. It wasn't designed to be a standalone strategy. However, I had clients who wanted to allocate money directly to this strategy, and so we opened it up for direct investment as well. It is a relatively smaller portion of our overall assets that we manage. but it does play a big part in our balance strategy. So I think it's important to get a good understanding of how it works. So this is the Flex Plus strategy since its inception. It was the last quarter of 2018. You can see the orange line, which is the Flex Plus strategy, relative to this market index. Again, the market index is an equally weighted average of the S&P 400, 500, and 600 indices. You can see the volatility just visually is very similar to that of the equity index itself. Looking at some of the quantitative measurements, however, you can see we've provided similar type returns to the market index, but we've done so on a reduction in volatility. The maximum drawdown in that strategy over this time period was significantly less, and the standard deviation is also slightly less than that of the market. So again, we're trying to provide and implement risk controls where appropriate. But again, this is designed to be an equity allocation strategy. It's going to have much higher volatility than what we were seeing in the core strategy. Let's take a look at what it's done over the last year. Let's zoom in. This is a chart of the last 1 year period. So you can see there's times where we outperform and there's times where we possibly even underperforming. You can see overall, though, we are in line with the overall equity markets. Drawdowns, again, are less, even in this 1 year time period. Standard deviation or volatility is less, and we've slightly exceeded the return of this stock market index. So the main point that I want to convey here is that this strategy is for long-term investment, someone who can tolerate a lot of volatility. Again, it was designed to be paired with the core strategy, but happy to provide it to those with the understanding that this is a much higher volatility type investment. So let me talk about this drawdown chart first. You can see, let's focus on these drawdowns. The orange line is the Flex Plus strategy. The gray line is the market index. You can see we had slightly less drawdown back here in 2018, actually significantly less downside during the COVID crash. This was 25% versus 38, 39%. You can see we went, we got out of the market. We're flat here for a while, missed some of this volatility. Got back in a little early here, so we participated in some more of the downside, but then we're able to ride that and get back to new all-time highs a little bit before the market did. You can see here during this last crisis that we had slightly less downside than the overall market. And this is what it looks like on a risk-adjusted return chart. You can see that the volatility here is significantly less than, say, the Russell 2000 small cap index and the NASDAQ, slightly less than the S&P 500. So how do we accomplish the investment decisions related to the Flex Plus strategy? This is what we call a weight of the evidence approach. This weight of the evidence approach guides all of our decisions. And what we do is we look at different market-based indicators, different technical indicators such as trend, momentum, breadth. We look at credit conditions. We look at different volatility measures and take a look at what the majority of those indicators are telling us. There's no one perfect indicator. And so we don't want to put too much reliance on a single indicator. But by combining these together, if most of the indicators are pointing to either a favorable market environment, its probabilities are higher that we are in a favorable market environment. If the majority of the indicators are pointing negative, more likely that we're in a negative environment. We also selectively use leverage through the use of those 2x funds that I talked about earlier when market conditions are more favorable. I want to kind of share a few examples. I think Ryan's going to walk us through a couple of examples. Are you there, Ryan? There you are.
I am here. Hey.
Awesome. So Ryan's just going to talk about, just give you a few examples of some of the things that we look at just to give you an idea of some of the indicators that support the Flex Plus strategy.
Absolutely. Absolutely. Yeah. And as Rob said, we're always looking for conditions, when conditions are most favorable to be a little more aggressive, to lean into leverage a little bit. I know that the Flex Plus has that ability, but probably hasn't done that as much as it probably could have. So that's something that we've really explored quite a bit, Rob and I together. Part of those updates became the new updated RGB scorecard, which is on the website, which is it's a little more technical leaning. It used to be a little more balanced. I think we've got a little more broadness in its technical leanings, but it's all across the long term, short term, momentum, volatility. There's a lot more going on there than there used to be. To give you a quick overview of some of the things that we're now looking at, is relative rotation. This is one of my absolute favorite things in that top left corner. And all these little arrows are all these sectors of the S&P 500. And I think you have the advanced decline on there as well. But it gives you a sense for how all the pieces of the puzzle are moving. And I like that because you can get a sense for, oh, if tech is not doing well, the index is going to have a hard time going up with that going down. So the XLK, for example, is at the bottom right corner in the weakening. That's usually not a real strong market. But you've got the XLP and the XLV, those are more defensive names pushing up and to the right, and they're up into improving and leading. And that says the defensives are doing okay, but that's not necessarily good for the broad index. So neat context you can get out of looking at relative rotation, because that's looking at both momentum and a relative strength ratio versus the T-bills rate. So a lot at you quickly, but I wanted to give just a quick overview of what that was. Another I love is directional momentum. That's just one of my favorite ways to hear about that is who's in charge? Is it the buyers or the sellers? Is that who's in control of the direction of the market? And it's a red over green or green over red in that bottom indicator. It looks like a mess, but when you're watching it in real time, you can go, oh, okay, look, the buyers are back in charge. It's now time. Conditions are good to start looking at being a little bit more aggressive, maybe adding leverage. Long-term momentum in the bottom left is just a long-term MACD. This is Rob's. I think this is fantastic. It gives a really good sense of when sentiment is shifting, when the movement is shifting. Because when markets are going up and they get tired, that you see the momentum slow, and that's when before they start to roll over. And I think what Rob came up here is a really neat way to come at it, and I really think it's helping give us context of the market, and it certainly did before this drop here in this past couple of months. And then finally, volatility. I love looking at the VIX index because it gives you a sense of fear in the market. Now, what's most interesting is when you get these big spikes, you can see there's a big spike up in the 50s during, just a couple months ago. Usually spikes are followed by a market rally. So this is the peak of fear. When you see these big peaks, that's typically going to be really close to a market bottom, maybe within a few days, maybe a week or so. But that'll give you really good context of going, okay, the market really had fear. Now we're going to move into let the fear subside. And that's usually when the market does start to rebound. When everyone's too afraid to get in, smart money's jumping in and making that happen. So long story short, short story long, those are some of the favorite things I'm looking at, but it helps us lean. It's going to help us lean into leverage a little more selectively, but keeping that risk control in place. So that's what I got.
All right. Thanks, Ryan. Appreciate it. Yeah, Ryan also referred to the stock market scorecard. I'm not sure if everyone's familiar with. We publish a dashboard of what the stock market is doing. It's on our website. You can look under the resources tab. It's updated on a daily basis. It's, what I find is mostly individual investors are the ones who are referring to it, but wanted to let you know that it's out there. If you have any questions about that, certainly let us know. We're happy to discuss that with you. Hopefully it's providing some value. And as Ryan said, a lot of the indicators that we use to manage our own money are supporting that dashboard itself. So let's move on to the balance strategies. As we said before, the balance strategies were designed to really take the best of the core and the best of the Flex Plus and bring them together to achieve what I would call below market volatility with the potential of participating in more of the upside of the market. So the word balance comes from just the balance between growth and risk management. As I said before, it's achieved by allocating 60% of the accounts to the core and 40% to the Flex Plus. And what I found is that's sort of a sweet spot. It really emphasizes that downside risk management, but also we're able to participate in the upside of the market. I think when we talk about risk profiles, the balance strategies still have significantly less volatility than that of the market. Typically less than half, between a half and a third of the volatility of the overall market. So even though we've got that exposure to the equity side of the stock market, we're just not participating in that day-to-day volatility that we see in the stock market itself. So let's take a look at how it's done. So here are the balance non-qualified, that's our taxable accounts in orange, and our balance qualified in the blue, compared to the equity index since its inception, which it started in the fourth quarter of 2018. You can see, again, just visually looking at this chart, the way this orange and blue line kind of move up and down compared to the gray line is just significantly less. You can visually see the reduction in volatility. You can also measure that through standard deviation. This is what about, as I said, it's probably about between a third and a half the volatility of that of the equity index itself. It's provided equivalent returns. Actually, the balance non-qualified, both of them have exceeded on the return side of things. You can see the 5-year return, not quite achieving that same return, but over the inception, we've exceeded that. Even on the 1-year side, we've provided higher returns, again, on lower volatility. And you can see the maximum drawdown for the equity index was at 39% relative compared to about 12%. That's about 1/3 of the drawdown. So, if this meets your risk profile, knowing that, the drawdowns are going to be about a third that of the market, then this might be a good place for you, as it'll provide a little higher upside over time, we believe, than the core strategy. Here's a 1-year chart zooming in. You can see how the strategy did during this most recent bout of volatility. Certainly avoided the big steep 23% drawdown. The drawdown in this time frame was really from this peak to this trough was about 8%. Again, about 1/3 that of the equity index. It exceeded on the return side for this 1-year period, and volatility again was about 1/3 that of the equity markets. During this 1-year time period, there wasn't a lot of use of margin from the core side. So you can see that these were pretty similarly invested throughout this 1-year time period, and that's why their results are pretty similar. That won't always be the case. When market conditions are favorable, the balance is going to have a little more exposure to the low volatility side of the market through its allocation to the core strategy, and hopefully we will benefit from that without dramatically increasing overall risk. Let's take a look at the drawdown chart. This is the balance qualified strategy first. You can see back in 2018, we had significantly less drawdown. Again, in 2020, we were just over the 10% mark, while the market was down, was at about 39%. We didn't participate in all of the drawdown during the 2022 inflationary period, and more recently during the last couple of months, our drawdowns were significantly reduced. Changing the slide to the non-qualified strategy, not much difference. The line looks very similar, and you can see that we've been able to avoid a significant portion of the drawdowns during the market downturns. And this is where it sits on the risk reward chart. As I said before, we can manage where we sit on this risk scale and try to achieve as much return as we possibly can. And so I think we've achieved that goal. And we'll talk about a little bit more about sort of where we strive to target that overall volatility levels for the different strategies in just a second. So here it is. So as I mentioned before, we can control risk, and we have very little control over the return we achieve during any period in the market. And what that means, as I mentioned earlier on in the presentation, is we can manage where we sit on this volatility x-axis, the standard deviation x-axis. We can decide to be at this end of the scale. We could decide to be at this end of the scale very easily by investing all in a money market or all in the NASDAQ composite index. That's going to give us high level of confidence that we're going to be either very low volatility or very high volatility, or we can create portfolios that sit anywhere along this scale. So each of our three strategies that we run have targeted risk profiles. So let's start with the most aggressive strategy. This is the Flex Plus. Generally, the Flex Plus is going to be between 4.5 and 6.5. We have the ability, based on the investments that we make, based on the risk controls that we implement, the risk profile is generally going to be sitting in this neighborhood. Because it's higher volatility, that range is a little bit wider than the other two strategies. As we move down the volatility spectrum, our balanced strategies tend to be between 1.5 and 2.5. I can control with a high degree of confidence where we will sit on this volatility axis. I have no control over how much return we'll get during any market environment. We could create a portfolio with a volatility level of 2, and we could achieve a 2%, or we could achieve a 10%. And I don't take any more risk when we achieve higher returns than when we achieve lower returns. And then our core strategies, both our core non-qualified and core qualified, tend to have, we target volatility levels between 0.5 and 1.5. And historically, that's where we've ended up. So if you believe that the recent volatility that we've experienced over the last couple of months was too great for you personally, I invite you to have a conversation with me. Let's figure out where we can put you so that you're not losing sleep next time the market decides to get a little crazy on us. It will happen again, guarantee you. There will be another pullback in the stock market. And now's the time, now that we've recovered from this most recent crisis, now's the time to have those conversations about where should we be allocated? What is our risk profile and how much risk can I take? One, for my financial objectives, but also two, just for my own sanity. No one wants to lose sleep at night worrying about their investments. So that's the conclusion of the strategy discussion. Now I want to shift gears and talk about how we deliver our services to our clients. First of all, I want to talk about our structure. How do we provide our services? Who are our partners? So RGB Capital Group is the investment advisor. As I mentioned before, we're a discretionary investment advisor. Our clients give us limited power of attorney to invest their accounts on their behalf. We use Fidelity as a custodian of the assets and the accounts. They are responsible for safeguarding your assets and making sure they track every transaction on that account and report that back to you, so you know exactly what's happened on your account. They provide that reporting in a couple of ways. They provide monthly statements. They also provide you 24/7 online access to your account, just like you would at any brokerage account. So you can log into your account. It is your account. It is registered to you. There's no commingling of funds. So you can log in. You can see exactly the positions that we hold, all the trades that have been placed, and the value of your portfolio. And this is very intentional. This separation of the custodial responsibilities from the investment advice is very intentional, and it protects our clients. There's no need for the advisor to have custody of client assets, and it provides a level of protection that benefits our clients. There's also a introducing broker-dealer called Ceros Financial Services. Ceros basically is an extension of Fidelity. They do a lot of the administrative work on Fidelity's behalf. So when we're setting up new accounts, we're working through Ceros, who is setting up the account on the Fidelity platform. When we process deposits and withdrawals, most of those go through the Ceros group. We've been working with them since we started the business in 2009. They've been a great partner of ours, and there's no added charges for either the custodial services or broker-dealer services here. There's no explicit charge. They make their money through other means by some of the investments that we make. For example, When we're in money market, when market conditions are weak, we tend to be in money markets. Those money markets are Fidelity money markets, and so they're making a little money off of those. When we borrow funds from margin, we pay interest on that. That interest goes to Fidelity and shared with Cirrus, but there's no out-of-pocket costs to our clients for their services. So with that, we also provide access to your accounts through two different portals. And I'm going to have Stephanie jump on here and talk about the different portals that we have.
So yes, good evening, everyone. We do have two portals that you can access to see different information on your accounts. So on the left, you see Wealthscape Investor. That is Fidelity's portal. That is the portal where you log in and you go directly into your accounts. And as Rob mentioned in the last slide, then you can see all of your holdings. You can see all transactions that have happened. You can see balances. You can pull up your statements. You can pull up your tax documents. Everything is on that website. The last point is mobile deposit. I wanted to talk a little bit about that. I'm sure a lot of you that you with your banks, when you bank with your bank and you get checks, you're able to log into your bank's kind of their portal, but it would be on your cell phone. And then you can take a picture of checks you have received for a mobile deposit. So Wellscape Investor has that ability as well. So if you receive a check and you have the Wellscape Investor app on your phone, you can mobily deposit your check instead of having to mail it in. You can still mail it in. And, if you want to do that and you don't have Fidelity's address, please email me. I can send that to you and tell you exactly how to get that check to them. But I just wanted to let you know there is that ability now on Wellscape Investor to mobily deposit checks. Now, the second on the right side is the RGB portal. That is specifically to RGB, where you will see your performance reports, you'll see your invoices, and then there is a folder out there that has your Fidelity statements and has your tax documents, because we do have a feed from Fidelity to our own portal. I will say though that they're delayed. So if you're looking for a statement, you're going to see it on Wellscape Investor before you see it on the RGB portal. But they're there in case it's kind of a one-stop shop on the RGB portal to see. It's just the Fidelity statements and tax documents will be a little bit delayed. So whenever you have problems, most of you clients know that when you have problems, you reach out to me if you can't, or if you're not able to log into either of these systems. So I'd like to tell you that when you email me, if you're having a problem, let me know in your email if it's Wellscape Investor that you're having an issue with, or if it's the RGB portal, because it's two separate things, two different things that I need to do to get that login back up and running for you. So the best thing to do is just to email me and let me know what your problem is. I can't log in. I'm getting errors, that type of thing. I will say though, the first thing that you need to do before you contact me is both Wellscape Investor and the RGB portal have a link that says forgot password. So if you're having any trouble, kind of your first step is to try that forgot password link. And what it's going to do is when you click on that, it's going to ask you to put in your email address. It will send you an email that has a secure link that you click on, and then it will walk you through changing your password. Try that first before you get a hold of me, because most of the time, I'm going to say 90% of the time, that's going to work for you. Once you try that, if that doesn't work and you're still having problems, please email me. I believe Lois put my email also in the chat, and it's also on this slide as well. Just email me and let me know the issue that you're having, and I will work with you to get your login working again. Another thing that this slide talks about is pretty much anything that you need on your account, you can come to me, email me on that. If you have questions on your account, not your investments, that's a Rob question. I won't answer anything on that. But if you have a question on your account, you have a question on, how to find your statements, you need money, if you need to take money out of your account, you can contact me for that. If you need to transfer an outside account into your account with us, you can call me for that, or any changes to your account, address changes, beneficiary changes, anything to do with your Fidelity account that is, I'm going to say, administrative, not your portfolio, not your returns, all of that you want to talk to Rob, but everything else you can talk to me about. I do want to say I am on East Coast time. Some of you know that, but a lot of you don't. So I am on East Coast time. So there is that time difference there. So if you email me at 4 o'clock Pacific time, you're probably not going to hear back from me until the next day. So I just wanted to let you know that that there could be a little bit of a delay, but not much at all. I think that's it. Thank you,
Well, thank
everybody.
you. Thanks, Stephanie. Appreciate it. Appreciate it, everything you do for us and our clients. Yeah, I just want to kind of reemphasize, the best way to get a hold of Stephanie is that email. It allows her to, prioritize and catalog the requests that come in. If she needs to reach out to you by phone, she will always pick up the phone and call you. But the best way is to send her that email, and we can address your concerns that way. Just a few other items before we conclude tonight's session. There's a few ways that I like to stay connected with our clients and those that want to kind of follow what we're doing. I think most of you are probably receiving the weekly note that we put out. It's called RGB Perspectives. It's either written by Ryan or myself each week. It's a one-page kind of quick summary of what's happening in the market and how we're reacting to changes in the market. If you just want a kind of quick weekly update, this is a great way to do that. If you're not already receiving it in the survey, there will be a way to let us know that you'd like to sign up for that. We'll put you on that distribution list. Happy to do so. I also produce a much more in-depth monthly newsletter. This is more intended for do-it-yourself investors, investors that are making their own decisions. And it really goes into a lot of the technical and market indicators that Ryan and I were talking about earlier. It uses that stock market scorecard that's on our website as a basis for much of the newsletter. We go in and kind of dig into many of those indicators and share charts that support the different trend and momentum breadth type sections of that dashboard. If you're interested in that detail of the markets, certainly happy to share that with you as well. Please let us know in that survey that you'd like to sign up. As Stephanie mentioned, we also send out monthly performance reports, so you always know how your account is doing. And those are our main means of staying connected with all of you. Obviously, always send us an email if you have questions, and we will respond either by email or by phone if it requires a phone call. If you ever need a meeting with me, I'm happy to schedule a call with you. You can also in the survey indicate that you'd like to set up a call with me, and we'll go ahead and get that set up as well. Lastly, I'd like to talk about our succession plan. Being a relatively small small investment advisor, succession planning is a very important topic that we need to deal with. And I've been putting together my succession plan for a number of years. And that succession plan really is focused on what if something happens to me? What if I get hit by that bus? That's where Ryan comes in. We brought on Ryan as a key component to our succession plan. I've known Ryan for over 10 years. As I said, he thinks a lot like I do. A lot of his investing that he does, we have very similar approaches to the market. We both value risk management and prioritize risk management. So he was really a great fit. It was really a great opportunity that allowed us to come together. If something was to happen to me, Ryan is on board. He has access to all of our client accounts. He has the ability to place trades. In fact, he places trades for us on a frequent basis. So he's familiar with all that. We have frequent conversations about the strategies themselves, about what's happening in the market. So he's well ingrained and in tune with everything that we do at RGB Capital Group. So if something was to happen to me, hopefully it doesn't, Ryan will just pick up the reins and continue to run on, and our clients will see no interruption of service and will have the confidence that their portfolios are continuing to be managed based on the objectives of the strategies that we discussed tonight. So that is our succession plan. As I said, hopefully we don't have to implement it. As far as my working career, I have no plans to retire at this point. I will always manage my own portfolios. So having the ability to share that with others that find value in what I do, I'm happy to continue to do that as long as I am able. So that's where we stand with the succession planning. Just to wrap up before we get to the Q&A part, just want to reiterate that we can't control the markets, but we certainly can control how we respond to them. And all of that has to do with risk management and management techniques that we apply to our different strategies. Our top priority is protecting capital when the markets are weak. We don't want our clients experiencing what I call life-altering losses. All of my personal money, all of my family's money, my mom's, my sisters, and other relatives are invested in these strategies. And so what that means is I will never ask my clients to take a risk that I'm not willing to take myself. We have money in all three of the different strategies. Ryan has money in the strategies. And at the end of the day, my goal is to help our clients invest with confidence, give them peace of mind, allow them to sleep at night. And those are the things that I need to be able to do this job, is to be able to sleep at night, to be able to invest your hard-earned money with confidence that you're not going to experience a life-altering loss. So when the markets get a little wonky and volatility picks up, just fall back on the principles and the concepts that we talked about today, that we're just not exposed to that same level of volatility in our core and balanced strategies. So with that, if there's anything we can do to help with your financial objectives and your financial plan, happy to have those conversations with you. So with that, I think Lois may put out the link into the survey in the chat. You can certainly click on it through the chat. You'll also be presented with a window when you exit the webinar this evening to fill out that survey. We really do appreciate the feedback and appreciate anything you have to say with respect to tonight's webinar. So with that, why don't we move on to Q&A if there's any questions, Ryan?
Yeah, there are a couple I think are worth hitting. Let's start with, going forward, will the market neutral strategy replace the moving average timing strategy?
Yeah, great question. The market neutral strategy we'll continue to use. I would not say it's going to replace the moving average timing strategies that we've used historically, but it's really designed to complement it. I think there's still a lot of value in the moving average timing, particularly if we get to a point where we get to maybe more of a recessionary environment and the markets decline. The Fed comes in and starts to lower rates to spur economic activity. It's going to be an awesome time to be back in the market. That moving average timing is going to be, that's what it's really well suited for, is when we get these big moves in the business cycle. So with that, we'll continue to use these market neutral funds as long as they're providing good risk adjusted returns. And so that's why, Ryan and I need to be adaptive to the market. As market conditions change, we want to be able to change with it. I still value the concepts of the moving average timing. At the end of the day, we're trying to create a risk adjusted return. If we create it through moving average timing or through market neutral funds or through some other means, it really is not that important. The important thing at the end of the day is that we provide good risk adjusted returns for our clients.
And I'd love to add, that's something that Rob and I continually discuss, which one to lean into, because it's really not a one or the other. It's like how much of this and how much of the other, and it's some sort of hybrid between the two. But as Rob said, there is going to be a point where the moving average timing and high yield is going to be an amazing trade, but we're kind of in this holding pattern until that hits. So we're watching that continually, discussing it, comparing notes, seeing how the setup is there. So it's something we watch continually.
Yeah, and in fact, we're in high yield right now. We have a smaller allocation to high yield right now in the core strategies and balanced strategies, and the reason it's smaller is because the market neutral funds are providing these just incredible risk adjusted returns right now, and it's hard to beat. That will change, guaranteed. That the market is very dynamic. It will change over time, and when we recognize those changes, we're going to be tactical and we're going to adapt and try to move to the portions of the market that are giving us the best opportunity to achieve those returns on low volatility.
Perfect. Early on, Rob, there was a question about institutional shares. I think just clarification of what those are.
Sure. So I think we're talking now back on those tier 2 services.
We use them as well in the strategies at RGB. So I think it really applies to both. I think it's worth mentioning.
Yeah. So mutual funds most often offer multiple what they call share classes, and each share class has a different set of fees associated with them. They all invest in the same investment. It's all vested in the same mutual fund, but the fees associated with these different share classes can vary. So there's A shares, there's institutional shares, the two that I mentioned before. There's other share classes as well. And they each have their own set of fee structure. The institutional share classes are designed for these big institutions, and so they tend to have the most favorable fee structures, meaning lower expenses, no transaction fees. But the drawback to those is individual investors on most brokerage platforms can't get access to them. However, on the Fidelity platform, we provide through the tier 2 service access to those institutional share classes. You're not subject to those large initial minimums. And as Ryan said, these are the share classes that we use in our strategies when they're available, because they are the cheapest funds, and we want to find the best funds at the cheapest cost for our clients, because at the end of the day, that just makes sense, right? We don't want to pay extra fees when we don't have to. And so those institutional share classes tend to be the most attractive and beneficial for our strategies as well.
Good answer. Excellent. Can you leverage for CQ and BQ, the qualified strategies? I believe I answered no, but I think it'd be better if you gave an expanded answer on that. So we don't typically use margin on those.
Correct. So it gets a little tricky. So there's two ways that we achieve leverage in our strategies. One is through the use of margin, and margin is used in our core strategies. Unfortunately, based on regulations, we can only use margin in our taxable, or what we call non-qualified accounts. We are not allowed to use them in our IRAs and Roth IRAs. There's nothing we can do about that. The second way we achieve leverage is through these 2x funds, which I described earlier. An example is if there's an S&P 500 2x fund. If the S&P moves up 1% in a day, the 2x fund generally moves up 2% that day. When the S&P 500 drops by 1% in a day, the S&P 500 2x fund is going to drop by 2%. The qualified accounts, the IRAs and the Roth IRAs, can access those 2x funds and achieve leverage using those vehicles that provide that additional exposure to the market. So yes, the balanced qualified does have access to some leverage, again, selective use of leverage through that Flex Plus sleeve, that 40% allocation to the Flex Plus strategy. So hopefully that makes sense. I know it gets confusing because there's two different types of leverage. One's margin and one are these leveraged funds. just to summarize, margin's not available in the qualified accounts, but we can access the leverage funds in the qualified accounts. In the non-qualified accounts, so balance non-qualified, BN, the strategy has access and uses both margin and the leverage funds. So hopefully that answered the question without confusing the situation too much.
Perfect. Thanks, Rob.
Yeah.
And then there's a question on tier 1 minimum went up, and somebody wants to know why.
Yeah. So we've moved our minimum up to 250. As you mentioned, it's just a matter of economics. We are trying to be as efficient as possible. And generally that relationship, we've recently moved up to the 250,000 mark, just to be efficient. We tend to spend a lot of time on when we accepted these smaller accounts, we spend as much time working on those accounts as we do otherwise, and just trying to be efficient and manage our accounts as appropriately as we can. Thanks everyone for joining in this evening. We certainly appreciate your time and participation. Please feel free to provide us feedback through that survey. We'd really appreciate that so that we know what we can do better in the future. Take care.